Hey guys, welcome to today's stream. I just want to preface today's stream with the fact that yesterday we were having significant issues with audio on both Discord and YouTube. So what I would love to do is if somebody in the Discord could confirm they can hear me and see my screen, that would be absolutely amazing. And also if somebody's watching on YouTube, could you please confirm that you can see and hear me? And that would be much, much appreciated. If the audio starts to cut out on any of the platforms, please just let me know. Just drop it in the comments of whichever platform that you're watching this stream on, and I will grab a link for either X or YouTube so that you can hop over from one to another. However, if you miss any of the session, they are all auto recorded and posted on YouTube and on X as well, so you can always go back and watch them. Usually the recordings are absolutely fine, even when there's been audio issues on the stream. It's generally related to like connectivity issues and stuff, and not the actual microphone itself. So with that out of the way, welcome to today's session. We're doing something a little bit different today because on Wednesdays we usually run the strategy development session. Thank you, Sachin, for confirming you can hear me. I really, really appreciate that. We usually run our strategy development sessions on a Wednesday. However, we have a really exciting session coming up tomorrow with the guys or the founders at Edgewonk, which is an industry-leading trading journal. They're actually coming in and helping me with the strategy development session tomorrow because they have a decade-plus long experience at doing this full-time, right? In analyzing traders, track records, looking at their journals, understanding the data and how to improve. And so because of that, we swapped that session to tomorrow and the Understanding Your Darwin session to today. Now, if you haven't been to one of these sessions before, this is a basic deep dive into some of the more advanced concepts that we have at Darwinex Zero. Things like your value at risk, risk adjustment, and all those sort of things. Okay, so FTNet is saying in Discord the audio is playing up. Please join YouTube stream. Audio is playing. I'm going to grab the link for them. I think maybe it's time to move all streams from Discord over to YouTube. Maybe that's the best thing for us to do. There we go. Awesome. So let's carry on. Now, my name is Kieran. I'm head of UK growth and business development here at Darwinex Zero. And if you're not aware of who we are, Darwinex is a regulated asset manager and broker. And we also have a licensed hedge fund as well. We're regulated by the FCA in the UK, by the CNMV in Spain, and also by the FSA in the Seychelles. Currently manage over $100 million in investor capital coming from third-party sources, and we have over 10,000 active strategies on both Darwinex and Darwinex Zero. Our job as a company is to help scale our traders. We're actively searching for the top trading talent in the retail space so that we can invest our own capital and bring external investors to you. Now, before we answer this question, I want to explain quickly what a Darwin is. A Darwin is essentially an index of your trading strategy, akin to the way that the S&P 500 is an index of the top 500 companies in the US, okay? Your Darwin is an index of all of the trades that you have ever placed, whilst trading with Darwinex, of course. It combines those trades with the risk engine's risk management on the positions. So that means position sizing and trade management, packages those two things together and builds the Darwin, which is the end result or the index. Now, you might think, why would I need one of those? What is the point? First and foremost, your Darwin is risk adjusted. So you see how your strategy performs at a risk adjusted level. So we risk adjust all the traders to the same volatility as the S&P 500, which we'll get onto shortly in the presentation. You come under the Darwinex regulatory compliance. So as I mentioned, we're a regulated asset manager. So if you're going to raise investor capital and manage it on your own, it's very difficult to do so. It's going to take a lot of time to raise capital firstly. You then need to get regulated. Otherwise, you're breaching a lot of laws, especially here in the UK. And it costs a lot of money. to get FCA regulated, for example, dependent on the type of business, you might be looking at high six figures, maybe even seven figures, just to lock up with the FCA to prove liquidity to conduct business. To be an asset manager, you may also need to have certain relevant qualifications. However, because it's only your trading signals and it's matched with our risk management or our risk engine, you can come under the Darwinex asset management license, meaning that your strategy can take investor capital without you having to become regulated yourself. Third, or lastly, you get a proven track record, both risk adjusted and non-risk adjusted level. So of course you get your Darwin, which is the track record of your trades plus our risk engine. But then of course you also get your broker statements, which you can either export or connect to MyFX book. You're connected to a regulated broker, which, you know, holds its weight if you're ever looking to apply for a job as a senior trader or a junior trader at a hedge fund or a prop desk, for example. You can of course take your broker statements from Darwinex because they know that those statements haven't been tampered with. Now, as I mentioned, because your Darwin is risk adjusted, your MetaTrader stats are going to look different from your Darwin stats. Now, our risk engine adjusts all of the traders' size on our platform to maintain a value at risk, or a VAR or VAR, of around 6.5% per month across the board. Value at risk estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, I appreciate that's a whole lot of words, so we do have an example to make it a little bit more understandable. So, for example, if a trader has a value at risk of $1,000, or in this case, let's say 6.5% like the S&P 500, with a 95% confidence level over one given month, it means that there's a 95% chance that that trader won't lose more than $1,000 in a single month. Of course, we can never give 100% guarantees because this is a market. Black swan events can happen. Markets can get overextended. Traders can do silly things. We can never guarantee 100% that an investor or a trader is never going to lose more than 6.5% in a single month. However, what we can do is mitigate the possibility of that happening by managing exposure, both when the trader opens a position and also whilst the trader is managing a position. So for an example, if a trader is opening random lot sizes, the risk engine may balance it out and start opening similar lot sizes so that it understands the risk continuity. It also will measure trader behavior. So if a trader on average holds trades for 10 minutes and their maximum holding time is 30 minutes, of course, the risk engine is going to be looking at the trader when they've started holding trades for 5 days and haven't closed them, and it's going to be taking a look at the difference in exposure, and it might start winding down those trades or those positions to protect the investor because clearly something has changed. Now, by us doing this and stepping in with a risk management element to the Darwin, it creates a level playing field, ensuring that every trader on our platform is judged based on their skill and not just the amount of risk that they're willing to take to generate a return. Now, this is really important because, especially these days, there's a notion that bigger is better. The bigger return is better. The more money I'm making is better. And quite often, the exposure that one takes to generate the return is often overlooked until there's an issue. Okay, so many traders aren't bothered about the risk that they take until there's some risk realized in terms of maybe it's a large drawdown, maybe they blow up their account, maybe they do some serious damage because they're running without stop losses, for example. But quite often it's overlooked until it's too late. When we're risk adjusting all of the traders so that all of those issues are mitigated, you truly see who can perform at a higher level, because you're giving everybody the same amount of ammunition to play with, essentially. Now, I have already answered this, but why do we use 6.5% VAR? So 6.5% value at risk is the S&P 500's risk level. We know investors are familiar with this and they're proven to tolerate it over an extended period of time. So what we're doing is adjusting your strategy to a risk level, ensuring it meets investors' expectations and risk tolerance. The last thing that we want as a business is for an investor to allocate capital to a trader strategy, the trader be a little bit high risk, have some unrealized loss, and then the investor pull their capital within a few days or a couple of weeks. It doesn't benefit the investor because the investor takes a realized loss. It doesn't benefit the trader because the trader doesn't keep their AUM, and it doesn't benefit Darwinex because our whole business is on building long-standing relationships between investors and traders. So what we do is we give investors access to investment products that we know aren't out of scope for them from a risk perspective. We know that it's in line with other things that the investors play around with. For example, stocks, the S&P, property. Every Darwin is not too out of scope in comparison to those other investment avenues. The great thing with the Darwin is that the upside, is infinitely higher. You might yield 9% on a property year on year, whereas your Darwin might yield 30%, 35%. Your Darwinex Zero dashboard will show your risk-adjusted metrics as a standard, apart from in the calibration phase. Then you will, because during the calibration phase, that's when our risk engine is trying to understand your behavior. So it will show your MetaTrader statistics. Once your Darwin is live, this will show your risk-adjusted statistics. If you did want to see your signal account statistics, you can click the signal account tab, and it will change the equity curve to show how much you've made on your MetaTrader account instead of your Darwin. Here's the value at risk chart that we provide to traders. And you can see to make it simple, we put a big white line on at 6.5%. Now, when the trader is above 6.5%, the risk engine is going to be reducing their position size at Darwin level to risk adjust their strategy down to that 6.5% level. So at the beginning of the chart, you can see they're roughly about 13%. Which is double 6.5%. So it essentially means that the trader's taking double the amount of risk that we offer out to investors. So for every 10 lots that the trader places on their MetaTrader, their Darwin is going to trade roughly 5 lots because it's 2 times the amount of risk. As that chart comes down, and remember, this is a living, breathing chart. It is a living, breathing metric. So it will update trade by trade, decision by decision. As the chart comes down, their risk multiplier, which works in opposite tandem with the value at risk, is going to increase. When they get to, I can see that people are complaining about the audio in Discord again. I'm just going to paste a link once more. As the trader's value at risk comes down to 6.5%, they're pretty much going to be at a 1-to-1 risk multiplier, meaning for the 10 lots they trade on Signal account, they're also going to see 10 lots on their Darwin because they're already operating at a 6.5% value at risk, and the risk engine doesn't then need to risk adjust them. As the trader goes sub 6.5% and keeps dropping in terms of their VAR, the risk multiplier is going to increase and increase and increase. As the trader hits 3.25% value at risk, the risk multiplier is going to be 2x. So at this point, for every 1 lot that the trader places at Signal account level, their Darwin is likely going to trade 2 lots there or thereabout because the risk engine is then scaling them up to 6.5% value at risk. We see this a lot with algo traders where they run multiple systems at low risk. They will likely see a risk increase or an exposure increase on their Darwin. Whereas manual traders generally tend to sit higher than 6.5%, but everybody is unique. A high or low value at risk isn't necessarily a good or bad thing. The only thing I say on that is there's an exponentially higher chance of an account being blown or a large period of drawdown if a trader is above 30% value at risk. So if you're underneath 30% value at risk, I don't think you have too much to worry about. Of course, the lower it is, the more healthier your Signal account or your MetaTrader account is going to look. It's going to be less volatile from an equity perspective. However, it's not necessarily good or bad. Some traders are more attuned to taking larger amounts of risk, and that's absolutely fine. But of course, with taking more risk, there is also a higher chance that you go into a larger drawdown or that you blow your account. It's just the nature of the game. Like I say, it's not necessarily a good or bad thing. On your own dashboard, this is a private metric. but you can see your Darwin live trades. Now, what this does is it shows you any trades that you're currently in, but it also shows you your risk multiplier that I was talking about and how many contracts that you're in on your Signal account versus how many you're in on your Darwin. So you can see in this example, the risk multiplier is 2.32x. So what that means in simple terms is every one lot or one contract that the trader places on their actual account, their Darwin is going to be taking 2.32 lots or contracts. So you can see they're in a Kiwi yen short position. They have 1.2 lots open on their Signal account or their MetaTrader, and their Darwin is in 2.79 contracts or 2.79 lots. We ensure fairness and consistency across all traders by having our risk engine risk adjust every single trader on the platform. So for example, we might have two traders. So we have trader A who trades with too high of a lot size. The risk engine might scale them down. We have trader B who trades with too small of a lot size, and the risk engine might scale them up. But what it's going to do is scale them both to the same level so that they're both taking the same exposure. If trader A now makes 5% per year, but trader B now makes 20% per year, we know that trader B makes a higher return with the amount of risk that they take. However, if they were non-risk adjusted, trader A might have made a higher return based on the fact he was trading with much, much higher risk. Your strategy's value at risk depends mainly on 4 factors. However, I do categorize these into 2 separate subcategories. You have strategy specific category, which is the asset volatility, the trade frequency, and the trade duration. Now, the higher the volatility of the asset, the higher your value at risk is going to be. The more trades you take, again, the higher exposure you take to the market, and therefore the higher value at risk you're going to have. Trade duration, the longer you're in a trade, the more time there is for a round trip, black swan event, winners to turn into losers, anything that you can kind of think of there. So again, your value at risk is higher. I don't ever recommend touching these 3 factors to change your value at risk. It doesn't make sense. Your strategy is your strategy, and you should keep it that way. However, the one thing that you can change if you did ever want to adjust your strategy's value at risk is your position sizing. So you have the strategy specific factors, which is 1 through 3, and then you have your position sizing category, which is your trade size. So of course you could be trading the lowest volatility asset, something like euro dollar. You could be taking 1 trade a month, and you could be holding that trade for an hour, so you barely ever get any market exposure. But if you're doing that with 1,000 contracts, of course you have a ridiculously high value at risk and a high chance of blowing up your account, which is why it's the easiest one out of the 4 to play with. It's not strategy specific. Anybody can increase or decrease their size, and it's very, very easy to implement. The only thing I would say is if you ever are going to change your position sizing at Darwinex, just do it slowly. Gradually bring it down over time, or increase it over time even, because the risk engine has a 45-day look back period. So it looks at your trading behavior over the past 45 days, compares it to a 6-month previous average so that it understands that you're not being over or under leveraged at any given point, and it works out that average for that period. So the last thing that you want to do is drop from 10 contracts to 1 contract overnight, because the average is going to be so out of scope with the new sample data. So bringing it down slowly will help that average decrease or increase over an extended period of time. Now, finally, before we wrap up the session, here's a few FAQs that we usually get. So number 1, when will my Darwin be listed? So regardless of when you start trading your Darwin, or when you pass your calibration phase, your Darwin will always be listed on the following Monday. So if you finish on Friday, you'll be listed on the following Monday. Finish on Tuesday, you'll be listed on the following Monday, and we'll go live. Number 2, should I stop trading whilst it's listed? I don't ever recommend anybody stop trading, not even for allocations or performance fees. If you're a trader, just keep trading. We're here for the long term, not the short term. And you should never override your edge with external factors like your Darwin being listed. Makes no difference, because your data still counts towards your live Darwin. Getting a performance fee or getting an allocation, it doesn't make sense. It might make sense in the moment to go, well, I'm guaranteed an allocation this month, or I'm guaranteed a couple of $100 in performance fees, or whatever it may be. But I always think, well, it doesn't really matter. What's my downside? Not a lot really. What's my maximum upside? Oh, there's quite a lot. And I just think you have to trust the process and let your edge play out. Number 3, should I increase / reduce my risk? I don't really think it's necessary, again, unless you're above 30% value at risk. At that point, you might need to take a look at it and think, you know, why am I operating at such a high level of risk? Is there anything that I can bring down? How to increase my risk multiplier? Again, like I say, it works in correlation with your value at risk. So there's an opposite correlation, or a negative correlation, I should say. To increase your risk multiplier, you just need to decrease your value at risk. How to do that? Decrease your position sizing. And number 5, last, is it bad to have a high or low multiplier? Same as having a high or low value at risk. There's no good or bad. Like I say, just be aware if you're over 30% value at risk, there is an exponentially large chance, or an exponentially higher chance, that you will blow your account than if you're sub 30% value at risk. That's what we've noticed over the past 13 years of being a company and tracking this data for traders. Anything above 30% is exponentially higher chance of having a big drawdown or blowing up their account. So finally, I just want to say thank you guys for attending today's session. Can you trade? Yeah, so we have a futures account with all of the assets available. You can check on darwinexzero.com/assets. You can check all of the account types on there and all of the individual assets. I don't know off the top of my head every single asset that we offer for each individual account, but you will be able to will be able to find that information. Let me grab the link for you so you can take a look. Anything that's on that page is tradable under the specific account type that you're looking at. Okay, guys, we're going to call it a session there. So again, as I said, tomorrow we're going to be joined by the founders of EdgeWonk. They're going to come in and run the strategy development session, which is the session that I usually look forward to running each week. So I'm handing the mantle over to those guys for tomorrow. We're going to see how it goes and then potentially bring them in on a more frequent basis. They are the experts in strategy development and trade journaling and all of that good stuff. So I'm excited to see what they can bring to the table for you guys. So I want to wish you all a good rest of your morning, afternoon, or evening, wherever you are in the world. If you're watching this on a recording too, have a fantastic rest of your day, and I will catch you tomorrow at 4 p.m. UK time for the strategy development session. Peace out, guys. Have a great rest of your day.